Opening your first trading account feels like standing at the edge of a cliff, doesn't it? Your hand hovers over the mouse, your heart pounds a little faster, and somewhere in the back of your mind, a voice whispers that you could either build real wealth or lose everything you deposit. That fear is actually healthy because it means you understand that trading is serious business, not some get-rich-quick scheme that internet gurus make it out to be. The difference between traders who build consistent profits and those who blow up their accounts in the first 3 months comes down to one thing. They learned the fundamentals before risking real money. Let me tell you something that nobody wants to admit in the trading world. Most beginners lose money in their first year, not because they're stupid or unlucky, but because they skip the boring parts. They jump straight into buying stocks or currencies without understanding what makes prices move, without learning risk management, without developing the emotional discipline that separates professionals from gamblers. If you're reading this right now, you're already ahead of most people because you're seeking knowledge before seeking profits. Trading is essentially buying and selling financial instruments like stocks, currencies, commodities, or cryptocurrencies, with the goal of making a profit from price movements. Sounds simple enough, right? Buy low, sell high, retire on a beach somewhere. But here's the reality that hits beginners like a cold bucket of water. Markets don't move in straight lines, prices don't always make sense, and your emotions will betray you at the worst possible moments. Understanding this up front saves you from the expensive lessons that drain bank accounts and crush confidence. Before you even think about placing your first trade, you need to choose what type of trading matches your personality and schedule. Day trading involves buying and selling within the same day, sometimes holding positions for just minutes or hours. This requires constant attention, quick decision-making, and the ability to handle stress without falling apart. If you have a full-time job or can't stare at charts for hours, day trading probably isn't your path. Swing trading holds positions for days or weeks, capturing larger price movements without the minute-by-minute pressure. Position trading stretches even longer, with traders holding for months or years based on fundamental analysis and long-term trends. Each style demands different skills, different time commitments, and different psychological strengths. The first practical step in your trading education is understanding what you're actually trading. The stock market is where you buy shares of companies, becoming a partial owner in businesses ranging from tech giants to small local enterprises. When a company performs well, grows its revenue, or launches successful products, the stock price typically rises. When things go wrong, the price falls. Currency trading, known as Forex, involves exchanging one currency for another, profiting from the changing values between pairs like the US dollar and euro. Commodities include physical goods like gold, oil, wheat, and coffee. Cryptocurrency brought us digital assets like Bitcoin and Ethereum that operate on blockchain technology. Each market has unique characteristics, trading hours, volatility levels, and factors that influence prices. Now let's talk about the unglamorous but absolutely critical foundation of trading, education. You cannot skip this part, no matter how boring it seems compared to making actual trades. Start with books written by successful traders who have survived decades in the markets. Learn what technical analysis means, which is studying price charts, patterns, and indicators to predict future movements. Understand fundamental analysis, which examines company financials, economic data, and real-world events that affect asset values. Free resources flood the internet, from YouTube channels run by experienced traders to online courses that break down complex concepts into digestible lessons. But be careful here because for every legitimate educator, there are 10 scammers selling overpriced courses filled with recycled information you could find for free. Technical analysis deserves your serious attention because this is the language of charts. Candlestick patterns show you not just what price did, but the battle between buyers and sellers during specific time periods. A single candlestick tells you the opening price, closing price, highest point, and lowest point for that period. String together hundreds of candlesticks and patterns emerge. Support levels are price points where buying pressure historically overcomes selling pressure, causing prices to bounce upward. Resistance levels are the opposite, where selling pressure pushes prices back down. Trend lines connect these levels, showing whether an asset is generally moving up, down, or sideways. Indicators like moving averages smooth out price action to reveal underlying trends. The relative strength index measures whether something is overbought or oversold. Volume shows how many people are actually trading, confirming whether a price movement has real conviction behind it. Fundamental analysis pulls you out of the chart and into the real world. If you're trading stocks, you need to read financial statements. Revenue tells you how much money a company brings in. Earnings show actual profit after expenses. Debt levels reveal financial health and risk. Price-to-earnings ratios help you determine if a stock is expensive or cheap compared to its profits. For Forex trading, economic indicators like employment reports, inflation data, and central bank decisions move currency values more than any chart pattern. Commodity traders watch weather patterns, geopolitical tensions, and supply chain disruptions. Cryptocurrency traders follow technology updates, regulatory news, and adoption trends. The best traders combine technical and fundamental analysis, using charts to time their entries and exits while using fundamental research to choose what to trade in the first place. Here's where most beginners destroy themselves: risk management. You can have the best trading strategy in the world, but without proper risk management, one bad week wipes you out completely. The golden rule that professional traders follow religiously is never risk more than 1 to 2% of your account on a single trade. If you have $1,000 to trade, that means risking only $10 to $20 per trade. Your immediate reaction might be that you'll never get rich risking such small amounts. But think about it differently. If you risk 20% per trade instead, 5 losing trades in a row and you've lost everything. With proper risk management, you can survive 20, 30, even 50 consecutive losses and still have capital to trade with when you find your edge again. Stop losses are non-negotiable for beginners. This is a predetermined price where you automatically exit a losing trade before it destroys your account. Let's say you buy a stock at $50, believing it will rise to $60. You set your stop loss at $48. If the stock drops to $48, you're automatically taken out of the position with a small loss. Yes, it stings to take losses. But small losses are the price of staying in the game long enough to hit your winners. Traders who refuse to use stop losses, who hold losing positions hoping they'll come back, who average down by buying more of a losing position. These traders eventually experience catastrophic losses that end their trading careers. Position sizing connects directly to risk management. This determines how many shares of stock, how many currency units, or how much of your capital goes into each trade. If you're risking 2% of a $5,000 account, that's $100 of risk. If your stop loss is $5 away from your entry price, you can buy 20 shares. The math matters because it keeps your risk consistent regardless of how far away your stop loss needs to be. Volatile assets require smaller positions. Stable assets allow larger positions. This calculation should happen before every single trade, no exceptions. Opening your first trading account brings you face to face with choosing a broker. This platform connects you to the markets, executes your trades, and holds your money. Research matters here because not all brokers treat beginners well. Look for low commissions, since frequent trading with high fees destroys profitability. User-friendly platforms help you avoid costly mistakes from confusing interfaces. Educational resources, customer service quality, and regulatory compliance separate legitimate brokers from sketchy operations. Read reviews from multiple sources. Test their demo accounts before depositing real money. Understand their fee structures completely because hidden costs lurk in spreads, withdrawal fees, and inactivity charges. Demo accounts, also called paper trading accounts, are where your real education accelerates. These simulate real market conditions with fake money, letting you practice without financial consequences. Spend at least 3 months trading a demo account before risking actual capital. Treat it like real money, feeling the sting of losses and the thrill of wins. Develop your strategy, test different approaches, learn the platform's features, and make all your beginner mistakes here where they cost nothing but ego. Too many traders skip this step. eager to start making real money, only to discover they have no idea what they're doing once real capital is on the line. Building a trading strategy gives structure to your decisions. Without a clear strategy, you're just gambling based on feelings and hunches. A solid strategy defines exactly when you enter trades, where you place your stop loss, what your profit target is, and under what conditions you exit. Maybe you trade breakouts, buying when price breaks above resistance with high volume. Maybe you trade reversals, looking for oversold conditions where price is likely to bounce. Maybe you follow trends, buying pullbacks in strong uptrends. Whatever you choose, write it down in detail. Back-test it on historical data to see if it would have been profitable. Forward test it on a demo account to see if it works in current conditions. Only then do you risk real money. The psychological challenges of trading catch beginners completely off guard. You can master technical analysis, understand fundamental factors, and have perfect risk management. But if you can't control your emotions, you will lose money. Fear makes you exit winning trades too early, missing the big profits that make trading worthwhile. Greed makes you hold losing trades too long, hoping for a miracle recovery. Revenge trading happens after a loss, where you immediately jump into another trade trying to win back what you lost, usually with larger size and less analysis. Overconfidence blooms after winning streaks, convincing you to increase risk right before the market humbles you. Recognizing these emotional traps is the first step toward managing them. Keeping a trading journal transforms your learning curve. After every trade, win or loss, you document what you saw in the market, why you entered, how you felt, what happened, and what you learned. Patterns emerge from these journals. Maybe you notice you lose money every time you trade before morning coffee. Maybe your best trades happen when you wait for 3 confirmations instead of 2. Maybe you perform terribly on Fridays. These insights, drawn from your actual experience rather than someone else's advice, become the foundation of your personal trading edge. Successful traders review their journals regularly, learning from mistakes and reinforcing what works. Understanding market conditions saves you from trading strategies in the wrong environment. Trending markets reward momentum trades where you buy strength and sell weakness. Range-bound markets punish momentum traders, but reward those who buy support and sell resistance. Volatile markets create opportunities for larger profits, but also larger losses. Quiet markets offer fewer opportunities but lower risk. Learning to identify what type of market you're in right now prevents you from forcing trades that don't match current conditions. Sometimes the best trade is no trade at all. Starting with one market, one strategy, and 1 or 2 assets keeps your focus sharp. Beginners often spread themselves too thin, trying to trade stocks and Forex and crypto all at once, jumping between strategies, never developing real expertise in anything. Pick one market that interests you. Master one proven strategy. Watch the same few assets until you understand their personality, their typical behavior, their unique quirks. Depth of knowledge beats breadth of confusion every single time. The amount of capital you start with matters less than you think. You don't need $10,000 to begin trading. Many brokers allow you to start with $500 or even less. What matters is using money you can afford to lose completely without affecting your life, your bills, or your mental health. Trading with scared money you need for rent or food, creates psychological pressure that destroys decision-making. Start small, prove you can be consistently profitable, then gradually increase your trading capital as your skill and confidence grow. Continuous learning separates traders who survive from those who disappear. Markets evolve constantly. Strategies that worked 5 years ago might fail today. New technologies change how trading happens. Economic conditions shift. Successful traders read daily market news, follow economic calendars, study new indicators, learn from other traders, and constantly refine their approach. Complacency kills trading accounts faster than ignorance because at least ignorant traders know they need to learn. Your trading journey won't be smooth. You'll experience losing streaks that test your commitment. You'll miss obvious opportunities and beat yourself up over them. You'll make mistakes that seem incredibly stupid in hindsight. You'll question whether you're cut out for this. These experiences are normal, not signs of failure. Every successful trader has stories of blown accounts, devastating losses, and moments of doubt. What separates them from failed traders isn't avoiding mistakes, but learning from them and refusing to quit. Trading offers genuine opportunities to build wealth, achieve financial independence, and work from anywhere with an internet connection. But it demands respect, discipline, continuous education, and emotional control. It rewards patience, punishes greed, and operates completely indifferent to your hopes, dreams, or financial needs. Start with education, practice extensively on demo accounts, develop a solid strategy with proven risk management, and approach your first real trades with humility and small position sizes. The market will always be there tomorrow, next week, next year. There's no rush to risk capital before you're truly ready. Your future trading success is being built right now through the choices you make as a beginner.